Okay, so ever try to make a quick buck? Not by selling stuff, but by noticing when something's priced differently in two places.
You mean like arbitrage?
Yeah, arbitrage, exactly. But we're talking about currencies today.
Ah, currencies. Now you're speaking my language. It's like a global flea market out there.
Right. And today we're diving deep into a specific type, triangular arbitrage. We even got our hands on some actual Python code.
No way! Having code that can actually pinpoint these opportunities, that's huge.
It's like having a secret weapon in the world of currency trading.
I mean, imagine trying to do this manually, tracking all those exchange rates constantly changing. Talk about information overload.
And that's where these algorithms come in, right?
Yeah.
They don't need coffee breaks. They just keep crunching numbers.
Exactly. And speed is everything in this game because in a perfect world, these arbitrage chances wouldn't even exist.
Right, like that whole no arbitrage condition thing.
Yeah, the idea that any price difference would be instantly noticed and exploited, poof, gone.
But thankfully for us, the market isn't always so perfect.
Thankfully. Otherwise, our deep dive would be pretty short, wouldn't it?
True that. So how do we find these real-world opportunities? Our research walks us through building a system for it.
Like building our own arbitrage detecting robot.
I like the sound of that.
Right.
And every good robot needs data, right? Lots and lots of data.
Absolutely. Tons of historical exchange rate data. Luckily, the Python code we're looking at today can just grab it all automatically.
Oh, thank goodness. No need to dust off the old spreadsheets then.
Definitely not. Once we've got all that data, the code gets to work. It uses some cool math to figure out what the exchange rate should be between two currencies.
Okay, so how does it actually do that?
It looks at how those currencies are doing against a third one. So, like, if we know the USD-EUR rate and the UR-GBP rate, we can use that to calculate what the USD-GBP rate should be.
Clever. So we're not just blindly looking for differences. We're using clues to find the most likely exchange rate.
Exactly. And here comes the fun part. The code then compares that calculated rate to the actual live exchange rate. And guess what? That difference, that's our potential arbitrage opportunity.
The spread, right? The trader's holy grail.
It is. But before we get too excited, there's another crucial piece to this puzzle. Transaction costs. Every trade comes with fees, spreads, and the dreaded slippage.
Ugh, slippage, the silent profit killer.
Right, that difference between what you think you're going to pay and what you actually end up paying, it can really eat into those profits.
So finding a price difference is only half the battle. You got to make sure it's big enough to cover those costs and still leave you in the green.
Exactly. And that brings us to another essential factor. Liquidity. You got to be able to actually buy and sell enough of those currencies to make it worthwhile.
It's like finding a killer deal at a store, but they only have one left, and it's not in your size. Super frustrating.
The perfect analogy. Having enough capital and being able to execute those trades quickly is key in the fast-paced world of currency arbitrage.
So maybe not a strategy for someone with just pocket change, huh?
Probably not. But hey, our code's done the heavy lifting, factored in those costs, even considered liquidity. What's the verdict on our triangular arbitrage opportunity?
So we've covered how to spot a triangular arbitrage opportunity, right? And we know transaction costs and liquidity are super important.
They're make or break factors, for sure. And to really see how this works in action, our research actually gives us a concrete example.
Ooh, perfect. I was hoping we could see some real-world numbers.
Absolutely. So we've got the US dollar, the euro, and the British pound in play.
The usual suspects.
Right. Let's say our system spots a potential opportunity. It's telling us the actual exchange rate for USD GBP is a tad higher than it should be, based on those USD EUR and EUR GBP rates.
So our algorithm's saying, hey, the pound's looking a bit pricey right now.
Exactly. And even though we might be talking fractions of a cent, these systems, they trade huge volumes super fast. That's how those small gains turn into big wins.
It's mind-boggling how quickly these algorithms can react.
It really is something. And what's cool about this example, it doesn't just stop at, here's an opportunity.
Oh, there's more.
It actually back tests the strategy.
Backtesting, so like time traveling to see if it would work.
Precisely. We use historical data to simulate how this would have played out. Tells us if we're onto something solid or if we need to tweak our approach.
Makes sense. Past performance isn't a guarantee or anything, but it's got to be a good indicator, right?
Exactly. And you know what? In this case, the backtesting shows that even with those transaction costs, we'd still be profitable.
Music to my ears. But if it's so effective, why isn't everyone doing this?
$1 million question. Remember, this type of arbitrage, especially with algorithms, it takes know-how, powerful tech, and a decent chunk of capital.
So it's a little more complicated than just like downloading the code and hitting go.
A little more, yeah.
Yeah,
That high barrier to entry is part of why it's not super common.
makes sense. But hey, we've had a peek behind the curtain today.
Definitely. We've seen how these opportunities are found and, more importantly, how they're exploited.
My mind is officially blown. But we're not done yet, are we? There's more to this currency arbitrage world.
Oh yeah, we've got statistical arbitrage to talk about still.
That's where things get even more interesting, right? Like predicting the future of currencies.
Well, maybe not predicting the future, but definitely a whole new level of complexity.
Bring it on. I'm ready for more. So, statistical arbitrage, how does that actually work in practice?
Okay, statistical arbitrage. So instead of chasing those instant price gaps, we're talking about predicting how currencies will move.
It's more like analyzing how they've moved in the past to find patterns, kind of like those hidden market rhythms.
So less about spotting a deal on apples today, more like forecasting next year's apple harvest.
Exactly. We're looking for relationships between currency pairs that most people wouldn't even notice.
It's like those currency dance partners we talked about, but now we're trying to anticipate their next move on the dance floor. Exactly. Imagine two currencies usually moving in sync. Statistical arbitrage looks for moments when they break step.
And the bet is they'll fall back into step eventually.
Right. The algorithm spots that temporary anomaly, tries to profit from it before they're back in sync.
Sounds like we're not just talking basic trend lines here. You mentioned something about cointegration. Now that sounds seriously complex.
It's all about finding a statistical link between things, in this case, currency prices. If they're co-integrated, they've got a long-term thing going on.
So even if they have their little spats, they always end up back together.
Exactly. And statistical arbitrage uses this co-integration analysis to find those pairs and then to predict their little breakups and makeups, so to speak.
Sounds like finding those couples who can finish each other's sentences but still have their own lives.
That's the idea. It's not about knowing the future perfectly, but about getting an edge, seeing those probabilities tilt in your favor just a bit.
It's both intimidating and fascinating at the same time, using all this data to get a glimpse into the future of currencies.
It shows you the power of these algorithms and how much data and analysis drives today's markets.
No doubt. But we had one more strategy on our list, right? Covered interest rate parity arbitrage. Even the name is a mouthful.
It's a bit of a tongue twister, but it boils down to how spot exchange rates, forward rates, and those interest rates all play together.
Okay, those terms I get. But how do they connect to arbitrage?
Imagine you're holding US dollars and you want to lock in a guaranteed rate to switch them to euros a few months down the line. That's where forward exchange rates come in.
So you're not gambling on what the exchange rate might do later on.
Exactly. Now, this covered interest rate parity idea, it says that forward rate should factor in the interest rate difference between those two currencies.
Meaning if euro interest rates are higher, the forward rate should reflect that.
Right. But the real world isn't always so neat. Sometimes that forward rate doesn't quite line up.
And boom, that's our arbitrage opportunity.
You got it. If that forward rate isn't reflecting the interest rate gap like it theoretically should, traders can jump in, try to profit from that mismatch.
So like borrow low in one currency, invest high in the other, and use that forward rate to lock in a risk-free gain.
That's the gist. But of course, it's never that simple. Transaction costs, liquidity in the forward market, those are all factors.
So even a tiny miscalculation could throw the whole thing off.
Absolutely. These strategies need serious understanding, careful planning, and often a good amount of capital to be worthwhile.
Well, our deep dive today has definitely shed some light on this whole currency arbitrage scene. From those lightning-fast trades to complex models and interest rate plays, it's been wild.
It's a whole different game than your average investing, that's for sure.
Absolutely. But hey, listener, this is just the beginning. We've only scratched the surface of currency trading.
Whether you're intrigued by algorithms or want to dig deeper into quantitative finance, there's a whole world out there.
Keep learning, keep those questions coming, and keep exploring the amazing world of finance. Because the more you know, the better prepared you'll be to make smart moves.
And on that note, until next time.